In the second of this series of webcasts, we turn our attention to the sea freight sector. I will be drawing from our latest report, Global Freight Forwarding 2012, which contains analysis of these trends, as well as market data, forecasts, market shares of leading freight forwarders, and their operational and financial profiles. In the past year, the container shipping market has been in the odd position of suffering acute financial stress for carriers, yet experiencing fairly solid underlying demand growth. This may be an odd situation, but is hardly surprising as the shipping industry is characterized by frequent oversupply. Although heavily influenced by depressed consumer demand in the US and the continuing euro crisis, underlying demand for container shipping has generally been reasonable through 2011 and into 2012. This chart shows Hong Kong and Singapore port volumes, which, as can be seen, have been on an upward trajectory, albeit weaker in Hong Kong. In fact, worldwide volumes through 2011 grew in the region of 7 to 8%, although this rate of expansion appears to be slowing markedly in 2012, possibly to below 5%. The pattern of container shipping traffic has also changed, with China-Europe and China-North America growing much more slowly, whilst Europe-China, North America-China, and especially intra-Asian trade growing more quickly. As far as sea freight rates are concerned, there have been high levels of volatility, as we can see in the next chart. The major issue is the volume of large vessels entering the market. Through 2011, capacity, as measured in TEUs, climbed substantially, hitting a level of over 16 million by the beginning of 2012. The overabundant supply situation seen through 2011 screamed lower rates. However, the market demonstrated that rate setting was not just an issue of available capacity as compared to demand. Rather, the shipping companies realized that if they continued on the dynamic seen in the first and second quarters of 2011, they would go out of business. This is probably not a sustainable situation. Losses amongst container shipping companies have been substantial over 2011, and there are clear signs that these companies have moved to increased profitability. This has been a mix of forcing rates higher through pricing discipline, and there also appears to be some evidence that shipping lines are scaling back their fleets. This has occurred through retiring smaller, older vessels early, and also by cancelling the later stages of their fleet expansion programs. Slow steaming has also been a factor, in effect reducing the efficiency of fleet utilisation. Using the Shanghai Containerized Shipping Index as a rough benchmark, we can see that rates on the China-Europe trade fell by over 50% during 2011, showing no peak season, which normally characterises the lead up to Christmas. The pattern was similar on the China-US trade as well. The trend reversed remarkably in December 2011, and this increase continued through the second quarter for rates to the US and only tailed off somewhat on the European trade. The general sentiment in the container shipping market is one of gloom for the prospects of container shipping companies. The combination of volatility in the provision of finance and the perception of oversupply calls into question the continued existence of a number of major companies, whilst even very large stable shipping groups are looking to diversify their investment out of the sector, often into areas such as contract logistics or freight forwarding. Is this pessimism overdone? Looking at the chart, we can see that there may be a reaction at present in the market which could lead to a violent reduction in the growth of the global container fleet. This could lead to a dramatic reversal in the balance of supply and demand around the middle of the decade. This would see much higher rate levels being sustained by the shipping lines, with the consequent negative impact on gross margin for freight forwarders. In our next webcast, we will be looking at the underlying trends affecting the air cargo sector. For more information on Global Freight Forwarding Report 2012, follow the link to the TI website.